Hello everyone, good afternoon and welcome to MF Corner. I'm Samira Abdi. Now once a month, sometimes in the first week of the month, or the first 10 days, we get the mutual fund data for the previous month, right? So which basically tells you where the money is flowing in, what kind of funds investors are preferring. So this month's data is as follows, and on the equity side of things, things are still looking at a little bit disappointing, if you can say, because I was actually expecting that for the month of Feb we would actually be seeing a small green line, or if not that, at least just a small red line. But it looks like the outflows have actually gone up by 700 odd crores, because if you look at the CAMS data for the previous month, which accounts for between 80 to 85% of the industry, was just showing a very negative number, and which is why this is surprising. So let's pull up the breakup of the equity funds to try and understand where the money is going out for. And this is not the exhaustive data, right? I mean, I've just picked up some of the big categories. Now, I'll get to multi-cap and flexi-cap in a bit. Let's start with large cap. Now, large, mid and small cap funds are where we had seen money coming in last month, right? But this month again we are seeing money going out of almost all three of these funds. So this is adding to a little bit of pressure. And where is the big pressure coming from? Which is this flexi cap and multi-cap category. Now you'd remember that SEBI had given out this new guideline which said that in the multi-cap category there would be strict allocations to large cap, mid cap and small cap, right? Which is why AMCs, the mutual fund companies, went back with a recommendation and said that, that's fine, keep the multi-cap category as it is, give us a flexi-cap category instead. And which is how this flexi-cap category was born. Now, over here, there is migration happening, right? So if you see over the last few weeks and months, a lot of the multi-cap funds have moved towards flexi-cap category. Let's just stay on the previous plate for a moment, right? Now, as and when that migration happens, right, as you move from a multi-cap fund to a flexi-cap fund, you will see this sort of change happening, right? So this would be negative, this would be positive, because that's the amount of money that is flowing in. Of course, there would be fresh money coming into, both these categories simultaneously as well. But the large chunk of money is as a multi-cap fund. A previous multi-cap fund now becomes a flexi-cap fund. So that is where the shift is happening. Now this month as well, there is a little bit of a curious case, right? Because you're seeing that the multi-cap fund has actually seen a positive number and the flexi-cap fund is seeing a minus 10,000 crore rupee number. So we're working on, understanding how exactly this is happening, because the money should be flowing from multi-cap to flexi-cap. I mean, multi-cap now is just a 20,000 crore rupee category, right? So how is it that a quarter of that money has come in this month? And, that is data that we're working on with AMFI. Now let's move on to the other categories, right? So there's equity, which we have seen. Debt has seen a slightly positive figure come through this time around. Hybrid has done well, and this is primarily the arbitrage fund which has done well, right? You'd remember exactly a year back, arbitrage funds had given negative returns for the first time in a decade or something. So this time around seems like, a year later they have come full circle. So arbitrage has done well this time around. And of course, passives continue to grow, not as good as last month, which was perhaps one of their best months, but nevertheless, that snowball effect has started. Within debt, the trend is very interesting, right? So liquid, of course, is its own animal. It's a quarter of the debt category, and it has its own vagaries, right? Month end, quarter end demands. Now the others, see this credit risk funds. There was outflows forever. For the longest time, we had seen some money coming in, but again, it's an outflow. Corporate bond is an outflow, which was actually a category which had benefited at the expense of the credit risk category. Banking and PSU, this had become a much loved category. This is seeing outflows, and short duration as well, 10,000 crores of outflows. So what does this tell us? This tells us that the big spike that we have seen in the bond yields, if we go back to that plate, is what is causing some bit of nervousness amongst investors, because the short duration category, if you see the SEBI definition, these are portfolios which have a Macaulay duration of between 1 to 3 years. So we are seeing, and even if you look at corporate bond and banking and PSU, a lot of those funds would be having bonds which have maturities of, definitely 2-3 year plus, right? Maybe 5 years. So the preference is shifting to portfolios which are under 1 year, right? So low duration, money market, liquid funds, stuff like that. So definitely there is some bit of nervousness about the spike in yields. Assets under management for the industry have gone up, so 31.6 lakh crores this time around. But another big disappointment will come in the form of the SIP data. So this time we've seen the SIP data actually fall off. So just about 7,500 odd crores of SIP from that 8,000 odd peak. So that is basically, how the data has shaped up for this month. But of course, a lot of inferences will be drawn. But for now, let's get started and invite our two experts. We have Harshvardhan Roongta of Roongta Securities joining in, and also Anand Dalmia of Wisdom is with us. So they'll answer some of the queries that have been coming in from our viewers. So gentlemen, good afternoon to both of you. Thanks very much. The first question comes in from Dharmesh Mehta, and he sent us a query on Twitter, right? So he wants to know more about arbitrage funds. I mean, how nice is that, Anand? Just this month, we have seen about 5,000 crores flow into arbitrage funds, a full circle, right, after a year. Would you say it's something investors should be looking at now?
Look, as the name suggests, an arbitrage fund basically tries to exploit the mispricing in the same stock between two markets. Generally, it is the spot and the derivative market. And the underlying return should be the short-term interest rate, that is prevalent. Now, why people like it is because, while the characteristic is that of a debt mutual fund, the taxation is that of an equity mutual fund. So 65% of the arbitrage has to happen in equities. As a result, anyone who is in the higher tax bracket and is looking at an investment with stable returns for more than 3 months and less than 3 years, I think arbitrage is still probably the best fund to invest in.
Okay, the next query today comes in from Sivaram Rangaraj, again a query on Twitter, and he wants to know about index fund and how the cost structure compares with other equity funds. So Harshvardhan, you'd be getting a lot of queries also, right, on this whole passive versus active. But, as far as I can tell, when people were first asking questions like, should I get an index fund or an ETF? The question now is, which one do I get? And perhaps even this, wanting to know about the cost structures, right? So what do you say to all of these people who are looking at passives? Does the cost structure really matter? I mean, in that space, because in any case, it's quite negligible, right?
Well, Sumera, you're right. So with regards to choosing a scheme, cost is definitely one of the factors. So if you're investing in a scheme which is charging you lesser amount as a total expense ratio, that directly adds into your kind of possibility of higher return. So cost is one part, but not the only factor that an investor should consider. In fact, when you talk about index funds or passive funds, I think it's just about time when we will see that more money will come into the ETFs and the index funds that we're talking about than what it is today. Now, if I was just to focus on the cost element, because that's actually the query asking what is the cost advantage. So if you just look at any passive index fund, so we're looking at say Nifty or a Sensex fund, you'll find that the cost is up to say 30 or 40 basis points. So it is 0.3 to 0.4% is roughly about where you will be paying your business scheme will be charging you for as an expense ratio. Now, on the contrary, when you look at an actively managed fund, because that's where the comparison this particular viewer is asking for, you'll find an average of an expense ratio in the range of say 100 to 150 basis points. Now, you will find some schemes which will charge you say 50 basis points, some will charge you say 250. So the range is going to be different. It depends upon the AUM of the scheme as well. But on an average, you can expect that 1% to 1.5% is what is going to be the cost for an actively managed fund. Now, an investor needs to definitely understand where the difference is and why there is a difference in the cost. For those who don't know this, index funds, as we've been speaking, is a passively managed fund. So the fund manager or the fund house does not really put in a lot of their efforts in constructing the portfolio. The portfolio is going to reflect and mirror exactly how the Nifty 50, for example, is. So if it's a Nifty 50 index fund, the fund will invest into those 50 companies that are forming a part of the Nifty 50, and also in the same proportion, in the same weightage that they have in the Nifty 50. So really speaking, there's not much of value addition that a fund house is putting in. So there is that's why the cost is lower. Now, from a comparison point of view, to make things simpler, just we pick up one single fund house and we compared the different, the cost structure between an ETF or other passively managed fund with an actively. So if we take the large cap category, Nifty 50 is of course the benchmark. So if I take the ICICI Prudential Nifty Index Fund and we choose a direct option, of course, the total expense, the expense ratio is 10 basis points. 0.10% is what an investor pays as an expense ratio on this scheme. Now, if you take a actively managed large cap fund, which is benchmarked for the Nifty 50 again, so you'll have a ICICI Pru Blue Chip Fund, and the direct option has a fund management cost of 1.22%. So 122 basis points. So this is essentially the difference in cost between a passively managed fund and an actively managed fund.
Right, and it does seem like perhaps passives are doing better, at least in the example that you've chosen. Okay, next up, Mahendra Yadav wants to know which categories of funds are best suited for regular systematic withdrawal plans, right? So what are systematic withdrawal plans? You put in money, into equities, and then you take it out in a phased manner. I mean, you can choose, the periodicity which you want to do. Anand, are some categories of funds better, or do you utilize it, at least in the accumulation stage when you're setting up your SWP? Do you use equity first, then debt, and then start your SWP? I mean, how does it go?
So generally depends on the tenure and the risk profile of the customer. Generally, I would say the rule of thumb is that, you try and do an SWP of an amount which is half the expected return of the fund. For example, if you expect a fund to give 10% returns in a year, the SWP that you should do is not more than 5%. You'll generally be good. However, in practical situations, what we see clients ask for is funds which are less prone to volatility, so that, in the initial months, it does not eat into the capital. So generally, funds like asset allocation funds or dynamic funds are funds that people look for when they think of an SWP. It's also more tax efficient for people in the higher tax bracket. So I would say generally try and look for funds which are less volatile. And if your tenure is long, you can choose anything. But if your tenure is like 5 years, try and stick to a dynamic asset allocation fund.
Okay, we have a lot more queries to answer, but we'll do that on the other side of this quick break. Stay tuned. Hi, welcome back. You're with MF Corner, and with us we have Anand Dalmia, co-founder and chief business officer at Fisdom, and Harshvardhan Roongta of Roongta Securities. So we've been answering some viewers' queries, and here's another interesting one. Manjeet Kothari has written in. He wants to know how to make dividend payout options in mutual funds as a regular source of income. So Anand, we discussed SWP, and there was a time when this dividend payout option would have been considered a source of regular income, not anymore. Would you go back and ask Manjeet to hear out your first answer on SWP?
Look, I would still say that, dividend, is no longer such an attractive option because of three things. Forget about SWP. Firstly, an AMC never guarantees a certain dividend month on month. So, if you're looking for regular income, there is no guarantee that you'll get a regular income. Secondly, sometimes even in a year when a particular scheme is not making a profit, the fund can actually announce dividends based on earlier profits. Now, this has a potential to eat into your capital, which is again not suggested. So I think SWP is a much better option because now in the last year's budget, your dividend is taxed at your personal tax rate. Earlier, people used to love it because there was a arbitrage between dividend distribution tax and your personal tax rate, especially for people who were higher taxed or in the higher tax bracket. So, I think a better option today is to go for a SWP with the same caveat that I said. It should be 50% of the amount of returns that you expect from the particular scheme that you invested.
Okay, Rohit Gajaria says that he is currently invested in the ICICI Prudential US Blue Chip and the Parag Parikh Long-Term Equity Fund for the last 3-4 years. They've both done well, and he has also partly managed to redeem about 20% of the units. Now he wants to know what to do. Should he keep the rest on, Harsh, or does he redeem the rest as well?
Very clearly, if you're talking about the schemes in specific, both these schemes are very good and there's no need to exit out of the scheme purely based on what the performance of the scheme has been. So when it comes to the scheme names, I would say it can most certainly continue. The other factor, whether he should redeem or not, would depend upon his requirement for the money. So now, if he does not need money for the next 5 to 10 years, then there is no need for him to withdraw. I mean, we've seen people coming back to us saying that markets have, come to almost all-time highs, and should we redeem now and book profits? So this is trying to time the market and ride a cycle, a bull cycle, and all those kind of things. But I think a retail investor should just sit happy with his, timelines. He does not need money for the next 5 or 10 years. There's no need to try and time the market and remove now. Things are fine. Don't need the money, don't redeem. If you need the money, of course you need to redeem the money.
Okay, fair enough. Sandeep Thakkar has written in on Twitter, and this is a bit of a follow-up really to the previous query. He wants to know how to approach the plan to get out of a non-performing scheme. So winners keep changing, right? And we have seen that in the past that, depending on the style of the fund manager, some funds have cycles when they do better than others, right? So if a fund currently is not doing well, how do you decide, Anand, that, this is the one I'm going to exit? How do you choose? It's like choosing between your kids, right? How do you pick one?
I would say, look, firstly, as you said, Samira, it should not just be on the basis of return, because every fund has a certain mandate and an investment style. Unless there is an issue with that, and, it depends on a lot of factors, you should not just try to exit a fund basis just the immediate returns or the returns in the short term. Secondly, I would say if you then decide to exit the fund, you get an advice, which is the right advice that, look, you should exit this fund. Ideally, you should choose another fund in a category which is similar characteristics to what you want for your long-term financial planning. What you need to keep in mind is the tax optimization and load optimization. Because, in equity mutual funds, if you withdraw before a year, there is a load. And depending on the tenure for which you're holding the fund for, you'll have either a short-term or a long-term capital gain. So you should optimize for these two things. However, I would say, as you said, it's difficult to choose between kids. Don't just go by the headline number. Try and understand why this particular fund has not performed and this category has not performed. So, investing in equities needs patience.
Okay, the final query today comes in from Kanchan Arora, who's written in from Ghaziabad, and she wants to know what is the future of ESG investing, what are the funds she should consider. And separately, Harsh, just today I was asked about the Invesco India ESG fund, right? So on both, your top bets and on Invesco, what is the opinion?
So with Sumera, if we talk about this ESG concept, this is more, the approach is towards, sustainable investing. So this is, I would say, a new kind of a conversation around ESG, where a company is, supposed to ideally shortlist an investable option based on the financials, of course. That is going to be the first thing. Then you further add another filter to say, what is this company's approach and, towards the environment, the society, what are the corporate governance processes that they're following. So honestly speaking, I think these kind of filters should be applied to all investments in all the schemes of a fund house. Why should you have this a specific fund?
Exactly my thought.
This is a fund that will, so this is a fund that will invest into these good companies, and the rest of the funds we are doing anything that we feel like. So that's not the idea. So I think, okay, since, and because now we have a query also very specifically, so there is some interest. The AMCs have been able to entice into investors to say, okay, now I want to invest into an ESG fund. But quite frankly, this should be applied all across the AUM that they manage, not only to a specific scheme. But because we have a very specific question from Kanchan and wants to invest only into an ESG fund. So another problem is with an ESG fund specifically. Most of the funds have just been launched. We are seeing just a few of them completing 1 year. Rest of them are very, very new. So how do you filter then? The criteria would be then you look at the fund house. What they have been doing with the equity AUM that they have. Not only ESG, of course, but otherwise as an AUM that they manage on equity or what they've been doing. So that is what we will possibly try and shortlist a scheme with. And the other is what is the AUM that they have garnered till now in that ESG fund. So I picked up two schemes that qualify in this filter of mine. I have picked up an Axis ESG equity fund, which has completed 1 year recently, and they manage an AUM in the ESG scheme of about 1,900 crores. The other is an ICICI ESG equity fund, which was launched in October 20, and they have an AUM of 1,500 crores. Now, if you ask me which one of the two are good, quite honestly, I don't know. Both of them are, shortlisted based on some filters that have applied, and so both are good. So according to me, I mean, whatever condition lies, just, I either throw a dart at any of the two, or just close your eyes and point at any one of the schemes and pick that. I think that's good enough for the moment.
Yeah, but I totally take your point, Harsh. I mean, we're good through the day, right? Not just when we come on air. So therefore, why narrow down ESG to just one fund? It should be across the spectrum. Well, gentlemen, thanks very much for joining in today and for answering these queries. With that, it's time for us to wind down now on MF Corner. But do keep sending us your queries. We'll take it up in some of the subsequent shows. For now, stay tuned. Closing bell is up next.